And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, the whole enchilada. It's the Lance Roberts Show, presented by Clarity Financial. It's life, money, and sweat equity. Now, welcome in to the Lance Roberts Show.
And welcome to the show today. It is, of course, Monday, and here we go, starting off the week. And, of course, well, today was actually one of an interesting day. Last Friday, when we closed the markets, a big rout last week, of course, we actually kind of held onto the 200-day moving average. The hope today was that we'd be able to get a little bit of a rally above that. In fact, we did spend most of the day really kind of ebbing back and forth, moving back into positive territory at a couple of times during the day, selling back off again. Unfortunately, at the close, we got kind of that last 30 minutes of the day, kind of when institutions come in to start playing in the market, really sold off the end of the day, wound up back at session lows. S&P down about 16 points at the close right now. So a couple of things that are going on here I want to touch on, and then want to go into a little bit of the longer-term backdrop that we discussed in our newsletter this weekend. We've also got Michael Leibowitz standing by, CFA. We're going to be talking about some of these market dynamics in more detail here in just one second. But this is a daily chart of the S&P, really going back here to the beginning of this year. And one thing that you'll notice here in particular with this chart is that when you're looking at this, there's a very definitive uptrend that was in the market earlier this year, and that has now been violated by this recent sell-off. More importantly, the 200-day moving average has also been violated. We broke that on Thursday, rallied back up to it on Friday, failed today. So we now have a confirmed failure at the 200-day moving average. So on a daily basis from a trading point, this is not good news. This suggests that lower prices are going to come. However, as portfolio managers, we tend to work on a weekly basis. So what we're looking for here is this to regain some support by the end of this week. If we don't get that support, we've got to start making some important portfolio management decisions in terms of potentially reducing equity risk in portfolios. Now, it's not just the daily basis that we're concerned with. If we take a look at this next chart, which is an important one, because when we start looking at these dynamics, and if I can get my thing to cooperate with me here, thank you. What we find is that the market here is very oversold on a short-term basis. In fact, the only times the market has been this oversold previously has been at short-term bottoms. And this is why we're a little bit reticent to do any type of real selling at this point. Typically, what has happened with this market over the course of the last couple of years anyway, is these very deep oversold conditions tend to be short-term bounces in the market. So you get this kind of a bounce in the market, you get some dip buying, so to speak. That gives you a better opportunity to exit positions than selling right here when we start to break levels of support. So we've seen the 200-day violated several times over the course of the last couple of years. Those previously have been buy the dip opportunities, and I'm not saying that this time is different, but there, as we'll go through in just a minute, there is some different dynamics that are currently working within the overall market. If we step back out here further, now this is a weekly chart, we see exactly the same thing going back through time when the markets have been this oversold on a weekly basis now. Also, we have seen this typically be buyable opportunities for the markets. Now, it doesn't mean that you buy here and the market just goes up from here. It simply means that you're going to get probably a bounce in the markets that gives you a better opportunity. As I said a minute ago, things are a little bit different this time, and something we'll talk about here in a minute. We have actually violated the 3-year moving average on the S&P 500 as well. So like violating the 200-day moving average, breaking the 3-year moving average certainly has some connotations to it that suggest a much weaker market environment, at least in the near term. And again, taking this chart all the way back here to 2004, we see exactly the same things. These deep oversold conditions tend to lead to tradable rallies. But look back here at 2006, 2007, 2008, you got an oversold condition that continued to get more oversold during the entire financial crisis. So simply just because you have an oversold condition currently doesn't mean it can't get worse, which is why we want to use a bounce in the markets to look at an opportunity to raise a little bit of cash, hedge some risk off in portfolios, and then just kind of wait and see and let the markets determine what they want to do next, and then we can simply reallocate to that. You know, one of the advantages of hedging risk is there's no risk to hedging risk. There's no risk and really taking some risk off the table. The risk is trying to remain fully invested, hoping this is a bottom, and it potentially turns out not to be. If the market does reverse here, starts improving in terms of performance, we can always put money back to work. What we're trying to hedge against is those unexpected catastrophic losses that can occur very, very quickly in the markets. Let's take a look at something we wrote this weekend in the newsletter in particular, because this is something that really kind of relates to this overall idea that something may have changed in the overall market. You know, speaking of rates, every time rates have gotten to 3%, we've seen the S&P 500 really starting to struggle in terms of performance. This wasn't any difference this time. As you can see here, every time that we've gotten up towards 3% in rates, we've had problems with the financial markets, of course, and that's not really surprising since rates really are a function of what happens in the overall economy. It impacts earnings growth, impacts economic strength. Of course, you know, mortgages, variable rate credit cards, all of our consumer debt is all tied to basically in interest rates. As interest rates go up, interest rate payments increase, the amount of money required to service debt, which removes disposable income from the markets. That weighs on both earnings as well as outlook for the markets going forward. It's not surprising that we also see the markets really start to stumble once interest rates hit above 3%. Secondly, we've got a very important signal here on a weekly basis suggesting that the overall dynamic of the market has now changed into a risk-off mode. Again, this doesn't mean that we're moving into the next great crash, the next financial crisis. It simply means that for the time being, reducing risk to equities may pay off, because typically during these periods where you have these type of indicators in place, market dynamics really have not been that favorable to just holding equity and holding equity risk. If we continue to look at this, again, we had this very nice uptrend that was going ever since March, and we've been this nice positive uptrend. We've been able to add exposure during this entire uptrend. A couple of weeks ago, we laid out these possible pathways for the market. And what happened here was that we violated that downtrend in the market, violated that uptrend. That has now led to a much bigger position here where we've got the potential for a further decline. We are currently flirting with that 2750 area on the market. Now, that's really important support here. It's a nice round number, which is a psychological support, but it's also important support for the markets. Again, a rally from here and a violation of that 2750 is likely going to lead to a retracement back here to lower lows. So again, the difference this time is that when you look back through here, we've never really violated this uptrend really ever since 2016. This is the first time we've actually violated that uptrend that's been in place since 2015. The second thing here is that we also have a very important topping process that's going on. It's the same topping process that we saw back in 2000 and 2007. You have declining relative strength. You've got a MACD sell signal. Basically, moving averages are beginning to converge here, and you are tied with a nominal new high. So in each case before this, we've had a nominal new high with declining momentum. I'm not saying that this is about to revert to one of these great market sell-offs that we saw back in 2000 or 2007, but you do have very similar actions that suggest that the markets, at least in the near term, may have reached their limit for the time being. So again, we just want to pay attention to this. And again, it's the same idea. The market's very oversold here, but any opportunity that we have for a rally is all within the context of a broader topping pattern that's currently in place. Even the best of outcomes right here, which would be a rally back to 29.25, which would basically be the all-time highs, is really limited by a massive amount of resistance that's currently overhead. We've got several Fibonacci levels to get through. We've got previous tops we've got to get through. So there is a lot of pressure on the markets from these resistance levels going back up. The worst outcome is a break down below recent lows, and of course that brings up a whole new dynamic in place. But the important thing here is that whatever we've got going on, it is going to be very unlikely the markets are going to set new highs this year. So between now and the end of the year, the best we can hope for is some recovery, but the odds of setting new highs and getting back into the bullish trend this year is going to be very unlikely. The problem with that is that moving into 2019, we began to get a deterioration across the board in terms of economic growth, earnings growth, as well as the outlook for the markets particularly as we start to wear off the effects of tax cut, tax reform. A lot of these hurricane spending is going to be reduced next year. And the problems with the fiscal debt and deficit really start to weigh on the economy next year as well. And of course, any change in the midterm elections that really takes away any ability for the current administration to pass any of their programs is going to weigh on market outlooks as well. So again, the best we've got here going into the year is a rally that gets us back to some level of this previous movement. That's going to be a good opportunity to really reduce risk, rebalance portfolios, and think about holding more cash and reducing overall allocation risk to equities as we head into the end of this year. So again, here's some of the things that we need to be looking at is reevaluate overall portfolio exposure. Again, highly likely that this current rally is not going to get us back to new highs. So think about reducing some of your overall risk tolerance. Reduce your allocation model. So if you're currently a 60-40 allocation, think about moving that to 50-50. As an example, look to add some bond exposure. Interest rates, unlike the stock market, which is extremely oversold, bonds are also extremely oversold. So look for to add some bond exposure to mitigate volatility risk. Also, you can read on our website the article called "The Upcoming Bond Market, Bond Bull Market." That's on the website now. Use rallies to raise cash as needed. Again, cash is a risk-free hedge. And of course, review all your positions. Things that aren't working, think about selling those. Again, keep your winners, trim them back a little bit, take your profits in. Again, that helps you raise cash. But again, kind of your basic rule of investing, sell losers, let your winners run. Look for opportunities in other markets. Gold may actually be finding a bit of shine here. Gold's been under pressure all year long. But again, it's one of those volatility plays. When volatility picks up in the market, money tends to move into gold as a safe haven play. Outside of that, also look to add hedges to portfolios. Again, if you don't know how to hedge your portfolio, that's fine. Use cash. Cash is a risk-free hedge, reduces volatility, but an opportunity may be coming up to basically add short positions and also take on other opportunities in other markets that can hedge off some of your volatility risk in the S&P and in your stock portfolios. And trade opportunistically. Again, as I just said, there's always rotations in the markets. There's always areas in other markets to go into, whether it's commodities or oil or gold or a variety of other areas. There's always a bull market somewhere. So if you can't make money in the market in the S&P 500, then look for other areas in markets that you can make money in. And again, as we continue to look at this, tighten up stop losses. Make sure that you have a stop loss, a position where you're willing to sell positions. And again, tighten those stop loss levels up. That'll protect you from losing a large amount of capital very quickly. So again, that's where we are right now within the markets, the portfolios. When we come back from the break, we're going to pick up with Michael Leibowitz, getting more detail on today's edition of Lance Roberts Podcast right here at realinvestmentadvice.com.
Want a longer talk with Lance about your money? Request a personal one-on-one at lancerobertsshow.com.